I'm Natalie MacDonald, back with another exclusive interview for you. UK PMI data has highlighted a second monthly contraction as the UK economy continues to weaken. Rob Dobson of Markit, the organisation which collates this data, is on the phone with me now. Rob, while today's number of 48.3 marks an improvement on February's four-month low of 47.9, traders had hoped for a larger advance. What factors held this figure back?
Well, what we're seeing still in the UK manufacturing sector is manufacturers being hit by lower levels of production, mainly reflecting a reduced demand from both the domestic and export markets. And what we're seeing is very much the subdued demand is leading consumers and businesses alike to rein in their spending, and that's leading to this downturn in UK manufacturing.
Cost is playing a significant role in the PMI numbers, as companies are driving selling prices higher in an effort to combat a contraction in new export orders. In your opinion, how long can this cyclical pricing trading pattern continue for? Or will companies soon need to lower prices in order to stimulate further business opportunities?
I think it can't last for much longer. A lot of this selling price rises is, A, to compensate for reductions in margins. Part of this is due to weaker exports, part of it is due to higher costs. However, what we're seeing is the domestic market for the UK very weak, we're seeing our main trading partner conditions there very weak, and we're seeing strong competition in markets such as the US and Asia. And at some point, UK manufacturers will find that in order to remain cost competitive, they may have to start reducing their selling prices to stimulate some demand.
This figure will inevitably raise the question of whether the Bank of England will implement further quantitative easing as a result of these flagging numbers. What are your thoughts here?
I think that what we'll see is the MPC, these numbers could be numbers which tip the balance towards more in favour of more quantitative easing by the Bank of England. What we saw at their last meeting was we saw three members saying that they actually were already in favour of more QE, and seeing that the industrial sector, which is very much the better indicator of the underlying business cycle in the UK, seeing that that's still in a downturn, that could tip the balance towards more quantitative easing.
And lastly, in a week where currency markets are hinged on central bank rate decisions, what impact is this data likely to have on the pound sterling?
Well, a lot of that expectation is due to the ongoing weakness of the UK economy as a whole. Now, we've seen data releases recently for the beginning of the first quarter of this year. We've seen them signalling that the UK should hopefully avoid falling into a triple-dip recession, as many people have been fearing. But again, a lot of this is going to rely on what happens in the much larger service sector, for which we're releasing data in a couple of days' time. But again, with the UK data still pretty weak, that is going to have a knock-on effect for the currency markets, with more expectations of weakness in the UK economy.
Rob, thank you. Stay tuned to Dukascopy TV for the latest Commodities Corner interview brought to you by Dear McDermott. But from me, it's goodbye for now.